there was a sentence quietly spoken at a closed-door AI investment summit that never made headlines. No press release, no breaking news alert. But it should have. A senior executive from a top U.S. technology firm told a room full of institutional investors that artificial intelligence could displace or fundamentally alter over $40 trillion worth of global economic activity within the next decade. Not over a century. Not eventually. Within 10 years. That number is larger than the entire GDP of the United States. Larger than the combined economies of China, Germany, and Japan. And this wasn't framed as a risk scenario. It wasn't a warning, it was presented as the base case. Because AI isn't arriving like previous technologies. It isn't replacing one industry at a time. It's attacking decision-making itself. The core function that justifies salaries, management layers, financial institutions, and even governments. For most of history, economic power belonged to whoever controlled labor. Then it shifted to whoever controlled capital. Now, for the first time, it's shifting to whoever controls intelligence at scale. And that's the part almost nobody is paying attention to. Because while the public debate focuses on chatbots and image generators, something far more disruptive is happening behind the scenes. AI systems are now outperforming humans in forecasting markets, optimizing logistics, detecting fraud, writing code, negotiating prices, and allocating capital. Quietly, relentlessly, exponentially. And once intelligence becomes cheaper than labor, once it becomes faster than management, once it becomes more accurate than experience, the entire economic hierarchy starts to break. This isn't about jobs disappearing. That's a surface-level fear. This is about why the current economic system exists at all. Every major economic collapse in history had a trigger. Not the real cause, the trigger. 2008 wasn't caused by Lehman Brothers collapsing. Lehman was just the moment reality became visible. And AI has its own trigger point. It didn't happen when ChatGPT launched. It didn't happen when AI beat humans at complex games. It happened when corporations quietly stopped hiring. Not because of recession, but because algorithms were already cheaper, faster, and more reliable. In 2024 and 2025, something strange showed up in U.S. labor data. Productivity rose, corporate profits stabilized, but white-collar hiring stalled, not crashed, stalled. Companies weren't firing aggressively. They just stopped replacing people. That's how disruption actually begins. Because AI doesn't announce itself as a threat. It slips into spreadsheets, into internal tools, into optimization systems. One AI system replaces 10 analysts, another replaces a compliance team, another replaces a junior legal department. Individually, these changes look manageable. Systemically, they're explosive. Because wages are income. Income fuels consumption. Consumption supports debt. And debt is the foundation of modern banking and government finance. If AI suppresses wage growth while increasing output, you don't get prosperity. You get imbalance. And imbalance always breaks something. The question is no longer if AI reshapes the global economy. That decision has already been made. The real question is what breaks first? Labor markets, banking systems, government revenues, or social stability itself? And that's where this story actually starts getting uncomfortable. Every time a new technology emerges, people reach for the same comparison. The internet did this. Automation did that. But that comparison breaks down immediately. The internet accelerated communication. It didn't replace judgment. Automation improved efficiency. It didn't replace decision-making. AI is different because it doesn't sit inside the economy. It sits above it. For the first time, companies can scale intelligence without scaling people. That single shift breaks every historical model economists rely on. During the internet boom, productivity gains eventually created new job categories. Web designers replaced printers, digital marketers replaced billboard buyers, software engineers replaced clerks. AI doesn't create replacement roles at the same rate it eliminates them. Because AI doesn't just assist workers, it absorbs their function. One AI model can replace thousands of hours of human cognitive labor instantly. No training curve, no salary negotiations, no burnout. And that changes capital allocation. When capital no longer needs labor to generate returns, wages stop being the engine of growth. Markets detach from households, profits detach from employment. That's not a cycle. That's a structural break. Which is why the smartest institutions aren't asking, how do we use AI? They're asking something far more dangerous. What happens to demand when intelligence becomes nearly free? Because demand is created by people, and people earn money by being economically necessary. Once that necessity erodes, the entire feedback loop collapses. This is why AI isn't an innovation wave. It's an economic gravity shift, and gravity doesn't negotiate. There's a misconception that AI will hit blue-collar workers first. History suggests the opposite. AI doesn't start with physical labor. It starts with structured thinking. Accountants, financial analysts, paralegals, consultants, mid-level managers. These roles exist to process information, reduce uncertainty, and make recommendations. That is exactly what modern AI systems do best. And unlike factories shutting down, this collapse doesn't look dramatic. It looks quiet. No layoffs on the evening news, no factory gates closing, just hiring freezes, role consolidation, efficiency initiatives. A department of 20 becomes 12, then 8, then 4. Not because the company is failing, but because it's succeeding without people. This is already visible in earnings calls. Executives openly credit AI for margin expansion. They just don't say where the savings came from. And here's the uncomfortable truth. White-collar salaries are the backbone of U.S. consumer spending. They fund mortgages, car loans, credit cards, and retirement accounts. If those salaries stagnate or disappear, consumption doesn't crash overnight. It decays, slowly, quietly, systemically. Banks don't fail because everyone defaults at once. They fail because cash flows stop growing. And AI is applying pressure exactly where modern economies are weakest. Income growth. This isn't a prediction. It's already measurable. And what happens next is what policymakers are terrified to say out loud. Banks don't fail because of technology. They fail because of math. At their core, banks are simple machines. They take deposits based on future income expectations, then lend against those expectations. Mortgages assume stable salaries. Auto loans assume predictable employment. Credit cards assume rising consumption. AI doesn't attack banks directly. It attacks the assumptions underneath them. When income growth slows, lending doesn't stop immediately. It just becomes riskier, and risk accumulates quietly. A single borrower losing income isn't a crisis. Millions of borrowers experiencing stagnant wages is. This is why banks are already changing behavior. Tighter credit standards, shorter loan durations, increased reliance on fees instead of lending growth. None of this is accidental. Because if AI-driven productivity gains don't translate into higher wages, the banking system inherits a structural mismatch. Assets priced for growth, supported by incomes that no longer grow. That's not a recession scenario. That's a balance sheet problem. And balance sheet problems don't resolve themselves. The most dangerous part? AI accelerates this process invisibly. There's no single shock, no Lehman moment, just a slow erosion of the cash flows that keep the system stable. And by the time the risk becomes visible, the exposure is already locked in. When faced with disruption, governments usually reach for the same tools: stimulus, regulation, job programs. None of them work here. You can't regulate intelligence out of existence, you can't subsidize inefficiency forever, and you can't force companies to hire people they don't need. AI doesn't eliminate jobs because it's cheaper. It eliminates them because it's structurally superior at certain tasks. And once a system proves superior, it becomes irreversible. Governments can slow adoption at the margins, but they can't stop global competition. If one country restricts AI, another deploys it more aggressively. Capital flows to efficiency. Always. This creates a policy trap. If governments intervene too aggressively, they lose competitiveness. If they don't intervene, inequality accelerates. Either path carries risk. And the fiscal implications are severe. Modern governments depend on income taxes, payroll taxes, and consumption taxes. All three depend on human employment. AI compresses all three simultaneously, which means the question is no longer whether governments will act. It's how long they can pretend the old system still works. Because once tax revenues diverge from obligations, the math breaks. And when the math breaks, policy follows. Most people think the danger is obvious. AI stocks are overvalued. Tech valuations are stretched. A bubble will burst. That's the easy story. The real bubble isn't in equity prices. It's in expectations. Modern economies are priced on the assumption that human labor will remain the primary driver of income, consumption, and tax revenue. AI quietly invalidates that assumption. Markets can absorb volatility. They can't absorb a broken foundation. If productivity rises while wages stagnate, asset prices don't immediately collapse. They disconnect. Capital concentrates. Returns compound at the top. Demand weakens underneath. That's not a stock market crash dynamic. That's a social balance sheet problem. And it shows up in places investors don't model: shrinking middle-class participation, rising household leverage, governments running permanent deficits, central banks trapped between inflation and instability. AI accelerates all of it, which means the AI bubble narrative is comforting because it implies a correction and a return to normal. There is no return to normal. There's only adaptation. And the systems that adapt first survive. The ones that don't get forced. Every major economic transition creates two groups: those who wait for clarity and those who move early. Clarity never arrives first. By the time AI's full impact is obvious in headlines, the structural shifts will already be priced in, socially, economically, and financially. This doesn't mean panic. It means awareness. AI doesn't destroy value. It redistributes it toward capital, toward infrastructure, toward ownership of systems rather than participation in them. The mistake most people make is assuming disruption happens to others. It doesn't. It happens quietly through incentives. Careers become less stable. Income becomes less predictable. Institutions become more fragile. And the people who fare best aren't the ones who predict the future perfectly. They're the ones who understand where pressure is building, because pressure always releases somewhere. And the final act of this story explains exactly where that release is heading. Every economic system eventually reaches a moment where it must choose between stability and efficiency. AI forces that moment. If societies allow intelligence to concentrate entirely in the hands of capital, productivity will soar, but demand will collapse. If they redistribute aggressively, innovation slows, and global competitiveness erodes. There is no painless option. This is why the next decade won't be defined by technology. it will be defined by political and economic redesign, new income mechanisms, new tax structures, new definitions of work. Not because they're ideal, but because the old ones no longer balance. The mistake is assuming this transition is far away. It isn't. The shift is already visible in labor data, corporate margins, and government deficits. AI didn't arrive with noise. It arrived with efficiency, and efficiency is unforgiving. The economies that survive this transition won't be the ones with the best AI models. They'll be the ones that restructure fastest. For individuals, the lesson is simple but uncomfortable. The future won't reward participation. It will reward positioning, understanding where value flows, where leverage concentrates, and where systems become fragile before they break. This isn't fear, it's reality. And reality doesn't wait for consensus. The AI economy isn't coming. It's already here. The only remaining question is whether you recognize it before it recognizes you.